Hi everybody, welcome to our discussion on this topic, which is impairment of assets. Friends, within the standard we're going to talk about a different terminology, which is a cash generating unit, or we also call it a CGU. Okay. Well, there's a definition, of course, given in the standard, which of course explains the meaning of a cash generating unit. But let's do one thing. Let's try to look at some examples and try to understand what could be the meaning of a cash generating unit, and then we kind of try to relate those examples with the definition given here. Okay. Think about it like this: that let's say there is a company which is into airlines. Okay, so what it does, it of course applies for a license to operate aircrafts, right? So let's say there is a license 1 between city A and city B. Okay. Likewise, it has license 2 between city A and city C, and let's say, for the sake of convenience, there is also a license to operate between city B and city C, right? These licenses could be with regard to takeoff and landing at a particular airport, and likewise, of course, operate those aircrafts. Also, it has many aircrafts that it operates between these three cities, right? So there are obviously interchange cities wherein these three licenses are operational. Now, when you look at the assets that this company owns, okay, we would say every individual aircraft is of course capable of generating cash flows, right? You're running an aircraft, you get your passengers on board, you sell them the tickets, you make money, and so the aircraft is essentially an asset and is capable of generating cash flows, which may be independent of cash flows generated by other aircrafts. Yeah. So here we are saying that each aircraft has its own capacity, own capability to create cash flows, right? You can obviously run one aircraft independent of other aircrafts, and accordingly we say that yes, one aircraft in itself is able to generate cash, so it becomes a cash generating unit. Are you fine with that? However, if I say that merely owning an aircraft without having licenses, merely owning an aircraft without having a license does not give the entity an opportunity to create cash. It does not give an opportunity to the entity to generate cash just because it is an aircraft, right? Which means that the aircraft and the license, let's say if there's an aircraft 1 which operates between city A and B, so you do not only need the aircraft to create or generate cash flows, but you also need the license 1 to be able to do that. Okay, you do not only need an aircraft, but you also need the license, because without license you cannot operate the aircraft. And it also goes the vice versa, because even if you have a license but you do not have an aircraft, you may not be in a position to generate cash flows independently just because you own the license. Okay, so what we are saying here is that in this scenario, the aircraft and license together are essential to be able to generate cash. We need both the aircraft and the license to be able to generate cash flows, which means that these together would constitute a cash generating unit. Are you fine with that idea? Yep. For the sake of convenience, let's say there are only 3 aircrafts operating individually amongst or between these cities. So let's say there is an aircraft 1 operating between A and B, aircraft 2 operating between A and C, and aircraft 3 operating between B and C, the cities there. Okay, so when I say that, I'm looking at a combination of aircraft 1 which operates between A and B. These together would become a cash generating unit. The cash flows generated by the aircraft 1 and the license between a license to operate between city A and city B together become a cash generating unit, right? Likewise, we say we have, so let's say there is an aircraft 1 for operating between A and B, and so there is an aircraft 1 plus license 1, likewise aircraft 2 plus license 2, and then aircraft 3 plus license 3. They individually, as a combination, I would say, A1 plus L1, A2 plus L2, and A3 plus L3, they would be separate cash generating units for me. Okay, so if I say and check my definition, it says that a cash generating unit is the smallest identifiable group of assets that generates cash flows largely independent of the cash flows from other assets or group of assets. I have a group of these 2 assets which are able to generate cash flows independent of the cash flows generated by A2 and license 2 or L2 and A3 and license 3, which is L3. Sounds okay? Yeah. Now let's make a twist around this further and see to it whether we are able to understand the concept even better. Let's say, for the sake of argument, that the airlines can only operate the aircrafts provided it runs aircrafts at or in or on all routes, right? So let's say there could be a route which is A and B, which is very, very highly profitable, right? 2 major cities. Likewise, let's say there is a license to operate aircraft between city B and city C, while B is a major city, urban, but then C is relatively farther, or let's say, backward or a rural area. Yep. Likewise, A and C also. So while A is a metro city, but C is again, let's say, a rural city. So just to ensure that the government makes it mandatory that if somebody has to operate an aircraft between A and B, which is certainly a profitable route, it also has to operate, let's say, aircraft between A and C and B and C respectively. That means what? That means that the aircraft 1 and license 1 now are unable to generate cash flows independent of aircrafts 2 and 3 plus license 2 and 3, licenses 2 and 3, right? What are we trying to say is, in this scenario, in this situation, the company cannot create or generate cash flows by only having an aircraft 1 and a license 1. It has to operate all these aircrafts on all the routes. Otherwise, they would not be allowed to operate the aircrafts at all, right? That means what? That A1 and license 1 cannot create cash flows without taking into consideration A2 plus license 2 and A3 plus license 3. That means that now all the assets together, so my cash generating unit will now comprise of aircraft 1 plus license 1 plus aircraft 2 plus license 2 and then aircraft 3 and also license 3, right? So this is where this entire set of assets will formulate a CGU, a cash generating unit, right? What is important here to pick up is to identify what is the attribute of an asset, whether it is having that ability to be able to generate cash flows independently or not. If not, then naturally more assets need to be clubbed so that a CGU can be formed. Okay, now why we want to talk about this is more important. Why do we need to understand the meaning of a cash generating unit? Why is it important for us? Yeah, we have been talking about impairment so far. So why do we want to talk about a cash generating unit, right? Let us say, just to address that question, let us say that I wish to do an impairment testing for a business. Okay, now this is different from, so we are saying here we are doing the impairment testing of a business and not of an asset. So we are not saying that we want to do a specific impairment testing of an asset, right? So if I put it like this, let us say that there is a bus operator okay, who owns 3 buses and 1 common license for root 1, root 2 and root 3 here. Okay, we are saying that the license is common for all the roots, and there is a bus 1 and there is a bus 2 and there is a bus 3. Okay, none of the roots can be operated individually, as in either all the roots would be operated together as a part of the requirement of the license, or else the buses may not be allowed to be operated. Okay, so when you say that, here we are saying that there is a group of assets, right, which is the license bus 1, bus 2 and bus 3. Let's say, for the sake of argument, the carrying amount of these assets individually is 10,000, 20,000. So let's say in dollars, let's say this is 15,000. That makes it 45, and let's say this is or maybe let's say this is 18,000 and this is 12,000. Okay, now this makes a total of, that is 30 plus 30, which is $60,000. All right, now we are saying that since the routes have to be operated in entirety, that means that the license and the 3 buses jointly are able to, or they can only generate cash flows jointly, otherwise they cannot they cannot generate cash flows at all, which means that these all assets together, the license and the 3 buses, would form a cash generating unit. Okay, so if I say that this is the carrying value of the assets for the business as a whole, and due to, let's say, some external factors, let's say competition, right? So there are many tour operators who have come, and it is expected that the business can probably generate cash flows of, let's say, or let's make it 48 here. It does not matter, by the way. Yep, let us say that the business can only generate cash flows of $48,000, while the value of the business as shown in the books is $60,000, right? That means what? That means that specifically or individually no asset has met an impairment loss, right? There's no indication of let's say a physical damage or a specific asset or a bus or maybe even a license getting impaired, but then the business as a whole is getting affected, right? So if I'm showing in my balance sheet total assets of 60,000, the overall recovery that I expect from the business is only 48, which means that my business has a worth of $48,000, or this CGU is worth 48,000 as against the value shown in the books of 60. That means that now it is my cash generating unit that is getting impaired. Okay, right? It's my cash generating unit which is getting impaired and not necessarily any specific asset. That means that I need to do the impairment testing or an impairment review of every such cash generating unit of the business. I have to do an impairment testing of every such cash generating unit of my business. So let's say if there is one city in which this company operates, it has a set of these licenses, and there is another city in which the company operates, that particular unit is not getting affected. That particular unit, that particular cash generating unit is not getting impaired because the competition has not reached there yet, or it is unlikely to reach there in future as well. That is where you look at that this specific cash generating unit is now getting impaired, right? That's the relevance or the significance of having a cash generating unit. Okay, what we are saying is, we are saying that if it is not possible to estimate the recoverable amount of individual assets, if it is not possible to estimate the recoverable amount of individual assets, an entity shall do the impairment testing of the cash generating unit or the CGU. Right? Here what we have said is the expected value of the business, the recoverable amount is going to be 48,000 as against the value shown at 60. That means that I need to recognize an impairment loss of $12,000. So the same definition of impairment loss where we said that the carrying value exceeds the recoverable amount, it does not now only apply to an asset, but it equally applies in the same manner it applies also at the level of a cash generating unit. Okay, so when I say I need to book a loss of 12,000 very quickly and without getting much into detail, we are saying that there is no specific asset being impaired. We are saying that the loss of 12,000 should be charged to each category or each amount of an asset or each type of an asset on a pro rata basis. Okay, when I say that, all I'm trying to bring forth, let me use some space here wisely. So I have a recoverable amount, which is the balancing figure. So I'm looking at my impairment loss now, right? Straightforward, 12,000 is the loss, 60,000 the carrying value, so 20% is the loss burden. Okay, so what we can safely say, this becomes 10,000 into 12 by 60, which is 2,000, which means that my recoverable amount is 10 minus 2, which is 8. This is of course 20,000 into 12 by 60. This is 4,000. Recoverable amount is 16. This is 18,000 into 12 by 60, 3,600, 14,400, and this is 12,000 into 12 by 60, that would be 2,400. This becomes 9,600. Of course the total would tally here. So 8 plus 16 plus 14,400 plus 9,600 will result into a value of $48,000, right? My objective was not to talk about how do we allocate the losses with respect to impairment for a CGU. That is done here, but that was not the primary objective. The primary objective was to essentially understand what is a cash generating unit And why do we need to have a cash generating unit? It is because if a business is getting impaired, and for example, in this case, we said that there is no specific asset that is getting impaired, that means that I have to identify individual cash generating units and allocate the loss or the impairment losses to the respective CGUs as applicable. Yep. What I need to do in a simpler language is see to it at a CGU level, at a cash generating unit level, I need to measure what is the possible amount of cash that a CGU is able to generate, and accordingly I need to provide and check the impairment loss as applicable to that cash generating unit. Yep, sounds okay to us. Yep. So what we are gonna, let's say, look at later is also to talk about how do you identify a cash generating unit. Yep. What are the different scenarios in which it might appear that we understand what could be a cash generating unit, but it could be a trickier situation sometimes. And then also look at it, once that CGU is defined, at what level do we keep it, and what if there are changes in that CGU identification later, then how do we deal with that, right? Broadly, the standard expects us to spend some time on understanding the allocation of goodwill to each respective cash generating unit, and then booking the impairment losses, right? So that is something which is the objective of our discussions going forward on this particular topic, which is cash generating unit within the impairment of assets. So I think I would want to kind of hold back that discussion until we do the subsequent mention on this the CGU concept in the later section. Good so far. So that's from my side. Good day and take care. All the best.